This is Joe Review's platform once again. Kindly subscribe to this platform if you have not done so, and click the bell icon to get notified when I release the next video. In this video, we shall be talking about how Forex trading works. Forex trading, also known as foreign exchange trading or currency trading, involves the buying and selling of currencies in the global foreign exchange market. It is the largest and most liquid financial market in the world, with an average daily trading volume exceeding $6 trillion. Forex trading operates 24 hours a day, about 5 days a week, across different time zones, allowing traders to engage in continuous trading activities from anywhere in the world. Here's a comprehensive overview of how Forex trading works. Number 1. Currency pairs. Currencies are traded in pairs, where one currency is exchanged for another at an agreed-upon exchange rate. Each currency pair consists of a base currency and a quote currency. For example, in the EUR-USD currency pair, the euro is the base currency and the US dollar is the quote currency. The exchange rate represents the value of one currency relative to another. Number 2. Market participants. The Forex market is comprised of various participants, including retail traders, institutional investors, central banks, multinational corporations, hedge funds, and speculators. Each participant contributes to market liquidity and price discovery by buying and selling currencies based on their investment objectives and trading strategies. Number 3. Trading platforms. Retail traders access the Forex market through online Forex brokers, which provide trading platforms that allow users to execute trades, analyze market data, and manage their accounts. These platforms offer a range of tools and features, including charting software, technical indicators, and order types, to assist traders in making informed trading decisions. Number 4. Market orders. Traders can execute market orders, which are orders to buy or sell a currency pair at the current market price. Market orders are executed instantly at the best available price in the market. Number 5. Pending orders. Traders can also place pending orders, which are orders to buy or sell a currency pair at a specified price in the future. There are several types of pending orders, including limit orders, stop orders, and stop limit orders, which allow traders to enter or exit positions at predetermined price levels. Number 6. Leverage. Forex trading offers traders the ability to trade on margin, allowing them to control larger positions with a relatively small amount of capital. Leverage amplifies both profits and losses, so it's essential for traders to use leverage cautiously and manage risk effectively. Number 7. Analysis. Traders use various methods of analysis to make trading decisions, including fundamental analysis, technical analysis, and sentiment analysis. Fundamental analysis involves evaluating economic indicators, central bank policies, and geopolitical events to assess the underlying factors driving currency movements. Technical analysis involves analyzing historical price data and chart patterns to identify trends and potential trading opportunities. Sentiment analysis involves gauging market sentiment and investor psychology to anticipate shifts in market direction. Number 8. Risk management. Risk management is a crucial aspect of Forex trading, as it helps traders mitigate potential losses and protect their capital. Common risk management techniques include setting stop-loss orders, implementing proper position sizing, diversifying trading strategies, and maintaining a disciplined approach to trading. By understanding how Forex trading works and staying informed about market developments, traders can navigate the complexities of the Forex market and potentially achieve their financial goals. However, it's essential to approach Forex trading with caution, discipline, and a well-defined trading plan to succeed in the long run. Till we meet next time on this platform, please stay safe. Bye for now.